All right, let's invite Matt Orton, Chief Market Strategist at Raymond James Investment. Matt, once again, thank you very much for joining in. I need to start the conversation with what's happening around AI back home in India. We've got the India AI Summit. All the big tech titans are, coming here to India. But you know what caught my attention yesterday was Anthropic's update. They've now announced a new update, Sonnet 4.6. And what's remarkable is that it comes just 12 days after their prior update, which is what caused the sell-off in global market. The pace of AI innovation, as AI is getting smarter, that AI is used to build another AI, which is even smarter. It's absolutely incredible, right? That in 12 days, we've got another update, and everyone's watching this with microscopic attention. Take us through your thoughts on this.
Yes, well, good morning, Raymond. It is amazing the pace at which things are moving on the AI front. But the speed at which it's moving should also be a reminder to investors that that pace is too quick to really come to brash decisions around what the overall long-term investment implications are going to be to a very large cohort of companies. So last week, I almost described as AI whack-a-mole across the market. I mean, literally, there were just drive-by shootings of a number of different sectors and industries, or anything that was perceived to be at risk of artificial intelligence coming in and taking away kind of future earnings growth for the market. And Indian IT companies were front and center in some of that action as well. But in my opinion, a lot of those reactions are overdone. A lot of high-quality investments have been thrown out with the bathwater. I'm not sure I want to be wading into a number of software names because, again, the pace of innovation is very rapid. It's too soon to know whose earnings are going to be potentially displaced. But a number of companies, and I would argue the Indian IT services names in particular, are really on the AI enablement side. They benefit from more companies, especially in the US and Europe, integrating and using a lot of this new advanced artificial intelligence. And I would also argue a lot of their own businesses can be enhanced for further margin by integrating artificial intelligence as well. So I think these dips are extreme. I'm a buyer on some of these dips once the dust starts to settle and we see a little bit of technical repair to the charts. But I like the setup long term from a risk reward perspective. It's overdone based on where fundamentals are.
Yeah. No, you mean, Matt, hi, morning. You mean Indian IT services stocks, right? That's what the comment was about.
Correct. That's right, Prashant.
Okay. Got it. Now, the U.S. market itself, Matt, I mean, is what's happening there? I mean, I think NVIDIA did well. AMD was down last night. Some are starting to say whether are we finally starting to see, on charts, etc., I've seen some start to talk about how these stocks are losing momentum. I mean, at least the large 7 names, 8 names. Is something changing finally, Matt? Yeah.
Something is changing. We're seeing a lot of dispersion across the market, and there's extreme dispersion intra-sector and anything kind of AI related versus those that are not. And I think the challenge, Prashant, with respect to where the market is that while seeing increased breadth and rotation is critically important to sustaining bull markets over the longer term, the challenge is the leadership also has to hold up as well. And where we are is we came from really strong earnings across most of those top 7 companies. And we're seeing significant weakness and a lack of interest in a lot of those names. And that keeps a lid on how high the market can go. And I can't help but think in the very short term that we're likely going to see a break. Something has to break. Either everyone realizes that AI is not going to eat everyone's lunch, and a lot of these market stalwarts, the biggest companies, are benefiting from these trends. Or what I think is more likely is we see a risk-off scenario in the very short term where that dispersion actually starts to narrow. A lot of the big beneficiaries that haven't moved up on fundamental strength, like consumer staples, for example, you start to see some weakness or reticence to start buying that, and you see a sell-off that comes across the overall market. That, I think, would be the opportune time for investors to start looking to buy the dip, because the fundamentals overall are strong. The macro backdrop is very, very strong. But I think we need to have some sort of shakeout to get investors to refocus on the underlying fundamentals and what are actually driving earnings going forward.
Hi, Matt. Morning. Good to see you in. Turning the attention a little bit away from equities, I want to talk about gold. Ray Dalio continues to sound very bullish on gold. But Bridgewater's latest 13F shows that they've actually exited SPDR gold shares. What's your interpretation of this? Is this the case basically of portfolio rebalancing, or do you think there's a bit of a shift in terms of conviction because gold from the recent peak actually has corrected a goodish bit? So your view on it.
Yeah, it has, Nigel. And I think it's similar to what I've been doing. I'm still very bullish on gold, both this year and longer term, but I've tactically reduced my positioning to gold. I still urge clients to hold at least, 1.5% to 2% in portfolios, if not more, just because of the diversification benefits you get. But gold rallied incredibly hard, incredibly quickly. And so I think it makes sense to take a little bit of chips off the table, allow there to be some repair. We're also in a very seasonally weak period for gold. Whenever you get to the Chinese Lunar New Year, it tends to be a very risk-off period for gold when you look historically. And so I think it's just a tactical play more than anything else. And once we get through the next month or so where we see this historical weakness, that's when I would look to start adding to positioning again, because there's still geopolitical risks. There's still challenges with respect to monetary debasement. We're still seeing central banks buying gold. And so I think that will keep long-term enthusiasm for the precious metal alive.
Matt, good conversation as always. Thank you very much for joining us and speak to you again soon. Thank you.